One. Hi, everyone. Welcome to another episode of the Bitcoin Law Review with your host, Tone Vays. We have two lawyers to start off the show. A couple of more can join us later. We are going to jump right into it as these shows do run long and some people can't stay on for the time. And on that note, we are joined by Stephen Pally, who has been on the show before, but not in a while, and a debut for Gordon Einstein, coming to us from California. Pally's coming to us from Washington, D.C. Hey, guys, welcome to the show.
Thanks.
Hey, man.
Happy to be here.
All right, Pally, you've been on the show. You've been on the show before. Give us a very brief intro and remind our viewers how they are familiar with your work. You are very active on Twitter.
I'm sorry about that, too. I just like to apologize to everyone who follows me on Twitter. In fact, I am actually a practicing lawyer. I do not own a herring company, and I may actually eat herring less than you think. I'm a partner with a law firm called Anderson Kill, which is a great name for a law firm, isn't it? And I'm a trial lawyer. I mostly focus on disputes, and I co-chair the firm's blockchain and virtual currency practice group. I also write a regular column with Nelson Rosario called Crypto Case Law Minute, which is syndicated. I guess that's just a fancy way of saying republished, which is republished in the Block Crypto. And I write a weekly piece for the Block Crypto's Gemini product as well on crypto and law and policy. So that's who I am. And it's a pleasure to be here again.
Awesome. Thank you so much for coming back. And Gordon Einstein, tell our viewers about yourself a little bit. It's your first time on the show. And you kind of came into the space not that long ago. You and I have run into each other at numerous conferences. And I've always enjoyed your presentations and amazed by the fact that every time I see you, you have like a new presentation on the latest hot topic in regards to law. So that's been great.
Yeah, so I really appreciate being on the show. I am a transactional attorney. With I guess a little bit of an interesting backstory is I became a member of the bar back in '95, but I stopped practicing law to start a cloud computing company. And I went back into law because of Bitcoin and crypto. It had this sort of black hole pull on me. So yes, I was exposed to it a few years ago. I switched careers again, I guess you could say, because of crypto. So that's just how much I love it. The thing that grabbed me once I finally began to understand the dynamics is twofold. I realized that crypto needs law, but also the law needs crypto. Because in my point of view, and part of the reason I stopped practicing for a while is I think the legal system is or was archaic and somewhat broken. Not a complete wreck, but has a lot of issues that need to be worked through. And I see blockchain and crypto and smart contracts and related technologies and approaches as a way of solving these problems. So not only do I have an active practice working with blockchain and crypto businesses and startups, but the reason you see me speaking at all these events is I'm trying to be sort of an international advocate for the industry, both in terms of interfacing with the regulators, but also helping the industry come into as much compliance as is necessary given the time so that it can be successful. So I'm very honored to be on your show.
Awesome. Thank you so much, Gordon. All right, we're going to jump right into our stories. We have lots of topics. Let's see how many of them we can get through. And we've had this on for quite a while. We always reference it. And this came out a little while ago now. It's already been like probably 2 to 3 months, but it's still so fresh. The framework for investment contracts as put out by SEC to just provide a little more guidance on what's going on with all of these tokens. I've read this over a couple of times now, and this entire focus on active participants is a concept we discussed here a bunch of times. And to me, an active participant is basically anyone that's involved in the original creation of the token. So even like a Charlie Lee and a Vitalik Buterin and any promoters and anyone else that directly benefits. And this itself references the famous William Hinman speech where he stated, and most people forgot the word opinion, though it's not here, but when he actually said it, though this may not be that, I think that was the speech, where he talked about how he sees Ethereum as sufficiently decentralized that while it might have started out as a security, it may no longer be a security. A lot of people like mistook that for an actual SEC direct statement that Ethereum is not a security, which I don't believe that they have officially stated. And from there, the latest that we've had was the approval of Blockstack's Reg A Plus token. And Reg A Plus came to my attention when I watched a presentation by you, Gordon, on the blockchain cruise, where you talked a lot about Reg A Plus. And now we've had a second company get approved for a Reg A Plus, which is YouNow, which again, like I have a fundamental problem with these tokens, which we can probably get into. But Gordon, maybe you can start and like say the difference between how these companies are trying to be regulatory compliant through Reg D, Regulation S. Now everyone is going to go for Reg A Plus. And what's going on here? We covered this topic last week as well with other lawyers, but it's good to have, you know, more, I guess, looking at this from another side.
Okay, so Reg A Plus is a big topic, and it's, how shall I hit this? There's different kinds of, first of all, one of my fundamental beliefs, and I assert that this is the case, and now the SEC seems to be backing me up, is that not all tokens are securities, despite what they seem to be edging at a couple years ago, because they've now admitted basically they're not all. And that there is such a thing as a utility or consumptive token, where everyone got messed up, if you like, in the ICO phase was the legal trap of selling what I call pre-functional utility tokens. In other words, they would, like a Kickstarter campaign, they would sell tokens to the public, they would collect the funds as a result of that sale and then use those funds to build the platform. Even if the resulting platform would be usable by those tokens, and the tokens are basically like monopoly money. In other words, they were true utility tokens. There's a very strong argument that prior to that network being built, at least for that period of time, the tokens are securities, because you're not really buying them to use them on the network, it's believed. You're buying them sort of in a speculative co-venture with the founders or the promoters of that platform. So there's actually, we're going into the weeds here, but everyone, of course, knows the Howey test about whether or not something is a security. The test that the SEC and others actually seem to be using was the California point of view, which is separate from those 4 prongs of the Howey test. Are you co-speculating along with the promoters in something that may or may not be built to completion? So I would argue that A+, and we'll get into it, A+ is a way of reviving the utility token ICO. Because if you admit that these tokens are momentarily securities, but you don't want to do a full registered offering under Section 5 of the 33 Act, or you don't want to not sell in the US, which is, I think it's a mistake to not sell in the US. Reg A+ provides sort of a lightweight tunnel to doing your revised new ICO. Now, there's 2 modes of doing an ICO or Reg A+ in the US. They're selling tokens that are securities and are going to stay securities. That's one issue. But I'd say there's an opening that people haven't really thought through, which is you can use these pre-functional tokens. You can sell those to Reg A+. And then, Steve, we'll get into this. I think based on what Hinman said with his Ethereum letter, I think you can make the argument that a couple of years following that A+, those tokens can stop being securities, and then you can stop complying with all the requirements that goes along with being a publicly traded security. Now, I know that's a little bit convoluted, and I think we'll go into the details in discussion.
But Reg A Plus is it's a way to raise money through a securities offering, right? So there, you've got Reg D is a little bit easier maybe a lot easier from a time, paperwork, and money standpoint. Reg A Plus is a little bit more complicated and allows you to raise more money, right? So we're talking about sort of the basics for people who are following along at home. You said that...
Let me jump in one moment for them. So just here's Securities Law 101 in 30 seconds. The default rule in the United States is that any sale or offer of sale of securities must be registered that's the key word, with the SEC under what's called Section 5 of the 33 Act. That's the default rule.
Right.
What Reg D is it provides for what's called an exemption from registration. Meaning you don't need to register with the SEC, which is great. And there's different rules, the most relevant being Rule 506B and Rule 506C, which are the usual ways of not registering because you're exempt. Reg A Plus is sort of a miniature version of a full registration. It's like a lightweight version. And the key difference is with the A Plus, you can really sell it to anyone, not a certain class of investors. And also you get immediate liquidity on the securities buy. You don't need to hold them. So go ahead.
Yeah, but you said something that I thought was curious. You said you thought it was a way of offering people the ability to do ICOs again. I'm not sure I necessarily follow you, or that I necessarily agree. You don't. When I think of ICO, I think of people actually, for the most part, actually selling unregistered securities, and not if they were doing a Reg D, maybe not even filing the Form D, or making sure that the people who were purchasing were appropriate purchasers. The ICO was Wild West, in my mind, ignoring securities law. I'm curious, I know you've read through a good deal of the Blockstack, the documents. I mean, what stands out about them? What's interesting about them from a transactional securities lawyer standpoint?
There's a few aspects, and they kind of complied with the SEC guidance. Let me take a step back. The way to sort of make the SEC be calm about these issuances is to do a full disclosure of all the information, which unregulated ICOs did not do, to have a stable or predictable value to the tokens. So, and there's certain protections in place for A pluses, which is usually you have to get what's called a registered transfer agent to handle all transactions in the securities once they're in the aftermarket. If you fail to do that, you, I think, need to register as, I forget the exact rule, but it's basically extremely burdensome. I need to go back over all the documentation. We were talking about this before. What stood out to me in Wilson Sonsini's response to the SEC's comment is they said that there's no need to have a registered transfer agent because the blockchain itself is not a person, and the blockchain itself will be acting as a transfer agent. I thought that was a very clever argument, and it kind of points to what I would view as the future of securities, which is we're not going to have parties or persons anymore. We're going to have sort of an automatic or algorithmic platform just handling all these transfers of value. Thoughts? Oh, actually, let me address your prior point. With ICOs in general, I agree the vast majority of them, especially when they were selling pre-functional security tokens, when they sold in the US, I think that they were in questionable compliance with the law. I'm going to be politically correct there. I'm making a slightly different argument.
I think you're probably being overly polite when you say in questionable compliance with.
I'd be massively overly polite.
Yeah, yeah.
Right? But I'm making what I think is a new argument that hasn't been made before, and I'm piecing together two pieces or three pieces. So there's three parts of this. Let's take the first premise. Let's take the premise that there is such a thing as a utility token. In other words, a token that's not a security, but that thing that can become a security, that can become a utility token while the platform itself doesn't work or while it's being built, may temporarily be a security. Okay, you don't necessarily have to agree to that, but a lot of people believe that a pre-functional utility token is going to be a security at least until the platform works or sufficiently decentralized.
I mean, if you look at the no action letters that the SEC has issued regarding tokens, you've got, what is it, Pocketful of Quarters, yes. And the other one was not Air Fox, it was the prepaid flight services. Basically, it seemed to me that what the SEC was saying was something that was rather perfectly obvious, which is that if you have a software artifact, which is essentially what these things are, you've got a piece of software that gives you the ability to acquire existing goods or services, then it's not a security. I mean, it almost, I read those and I thought, okay, I mean, it's a shame that we had to go through the step of a no action letter to state what seems like the obvious. And you're a software guy, right? I mean, software tokens exist outside of the rubric or concept of blockchain. So it seems to me like the very, I never liked the language utility token because it suggested to me that, I don't know, it was a way of imbuing a non-securities status to a piece of software. It seemed like in perhaps in a dangerous shorthand fashion I never quite understood. So I see we have up on the screen the pocket full of quarters, no action.
Yeah, go ahead. I want to get in on this. So Gordon, I'll let you answer, Pally, and then I have some questions I want to throw at you.
Sure. So here's a top level view. I think that the guidance, quote unquote, that the SEC provided, the overall guidance, and their 2 no action letters are almost the opposite of useful, because they took such a conservative position in their framework for analyzing digital assets, and it took such extreme, obviously non-security cases and granted these no action letters, that if that's actually where the border is between the security and the non-security, then that's a problem. They could go a lot looser than they were and still be logically out of securities territory.
But they're responding to, I mean, the response is a response to a much longer correspondence. So like if you look at Lewis Cohen at DLX wrote the letter to the SEC for pocket full of quarters. I actually look at the SEC response, the no action response, and basically what it's doing is it's tracking Lewis's letter.
Right, so on my right screen, I actually have his letter up right now. I think that we have a unfortunate cycle going on, which is the SEC has been very conservative and unclear. I think that lawyers are now dominating the setup of these token and tokenomics, and so that they can frame these things as non-securities.
Sure.
And of course, they're submitting these letters, and the SEC is approving the thing that they basically told the lawyer to submit anyway. The pocket of quarters is great. It's neat that a 12-year-old came up with it, but the fact that these things pretty much are not exchangeable, they have what's basically static value.
Sure.
It's all kind of, like you pointed out, it's kind of, the moment you have static value, you have no expectation of profit, and you clearly don't have a security. It's kind of
security,
like
right. Prepaid services. I mean, there are no action letters going back for decades that talk about, I believe there's one for prepaid legal services, actually, long before blockchain. So, right, that's the curious thing. My assumption is that because people were building things using ERC-20 tokens, and they didn't want to get in trouble with the SEC, the safe thing to do is to get a no action letter. But if you look at it, like I think we can imagine imagine a history where there wasn't the ICO abuses, where people weren't raising $50 million for something that didn't exist. If we hadn't gone through that, I almost wonder if something like pocket full of quarters would have bothered, because it is so clearly not a security. This is not an investment contract. Same thing with the prepaid air charter service. It is really, I'm not sure that we may disagree philosophically on whether or not the SEC should be taking a different approach, what it would mean for them to be less or more conservative. But I think we can both agree that these things, it's almost like you look at it and you're like, well, that's not a security.
Can I comment on this? I want to jump in here. So I agree with you guys as a non-lawyer, like my opinion matters, but that like these 2 no action letters, like these things are obviously not a security. And to me, I think the reason why they had to get these no action letters is because they are ERC-20. And the fact that they are on top of Ethereum, and Ethereum itself is in this limbo state, were they a security? Are they decentralized enough? It's a new database. Now, if this had been done on top of, let's say, Amazon's AWS, they probably would not have been filing for these things. And this goes to my argument from 3-4 years ago, long before the show, no one needs to do these damn tokens on a decentralized platform. It's completely unnecessary unless you're actually looking to have speculative value in that token. And my other part that I wanted to say, going back to Blockstack, YouNow has a whole different complaint from me. But the whole thing with Blockstack, and you mentioned it, Gordon, this idea of the way Blockstack's lawyers, I guess, got around the transfer agent problem by saying that, well, wait a minute, we don't execute this stuff, the blockchain does. And I have a technological problem with this because I don't believe any of these projects are decentralized enough to claim that the blockchain is doing it and the people coding it have no influence in changing that. And this is the same problem that I have with Hinman saying that Ethereum may be sufficiently decentralized, and people that hate the SEC like to no end, even, but they happen to hate Ethereum more. And they're like, well, wait a minute, that's crazy. Like, I don't want, the SEC involved in anything, but like Ethereum is not decentralized, right? And people that are blockchain engineers know that Ethereum is not decentralized. And this is where like our conflict comes in with a lot of these statements, because I don't think the SEC I don't think they're consulting the right blockchain engineers to educate them on the technology.
So you raise an issue that I want to state it a little bit differently. Also, I wanted to say, Tone, why do you hate freedom?
I know, I get that a lot. No, yeah, because I hate people lying and claiming bullshit and profiting from it.
Let's set that aside. Like, we know you think Ethereum is bullshit, right? I get it. Everybody listening gets it. But there's a different question that I might frame it differently, which is the SEC, are these things subject to additional scrutiny because they are synthetic assets built on something that is arguably the product of an unregistered securities offering? I don't think that's why, but that's an interesting question. So another way of thinking about it would be, if Ether is a security, and like it or not, maybe it's not at this point. We don't have a definitive answer from the SEC, in spite of what some folks have said. But if it is a synthetic asset that's created on top of it also would that also be a security? And if so, is that part of the problem, or is that a reason for additional scrutiny? I don't know if anybody's actually ever looked at that question.
Can I jump in on that one?
Please.
I'd say that I think Tone's argument is unique and interesting, but I think there's two ways of looking at that. If you have a platform that's built upon a security, that does not itself make the platform a security. That's number one. So even if Ethereum is a security, that doesn't necessarily mean that something using the Ethereum network or gas would itself inherit that status, especially if the value is staying static somehow.
It's a completely novel issue, though. Do you really think there's a...
Let me just add one other thing. I think the thing that might make them a security is if these internal tokens for either of these no action letter platforms was somehow exchangeable for Ethereum. Because if the value of Ethereum is a security and the value of Ethereum is fluctuating, and you're basically getting a marker you can turn in for Ethereum. Then
well, you actually, Gordon, in this case, in Pocket Full of Quarters, you could, but it's only by very specific people that have been KYC AML. It says it right there.
Right, but that would not change, and people complain this all the time, but that would not change its security status. The fact that you didn't know your customer and anti-money laundering on the person does not change the fact that they own Apple stock is a security.
You might go to prison for violating the Bank Secrecy Act, but the AML KYC doesn't go to the status of something as a security.
Right, and also, Tony, I'm pointing out to you, I don't think either one of these no action letters, looking at the attorneys requesting them, I don't think either one of them was trying to addressing the argument that these things are not securities because they're built on Ethereum.
Yeah, I agree. That's
I'm with you. I'm with you on that. But like the fact that they are an ERC-20 And we've seen 99.9% of everything else as an ERC-20 just being traded for speculation. This is probably why they're making it clear that while all this other ICO stuff as ERC-20 are probably unregistered securities, this one isn't going to have those features, even though it's still an ERC-20.
I don't agree with you. I say the reason all these other tokens that are built on ERC-20 are probably securities is twofold. Either they're pre-functional tokens, so they're being sold before the platform is ready to use. So they're speculative, or they have inherent security like characteristics like they're paying dividends or their equity or something like that. The mere fact that they're built on the Ethereum platform does not by itself have an inherent security status.
I think that's probably right. It's maybe it's just an interesting thought question. I don't know that anyone has, I don't think that has been raised in either litigation or in any of the no action letter requests.
And Tone, let me throw something else at you. When Commissioner Hammond made that statement about Ethereum or voiced his opinion about Ethereum, there's two separate things. There's, his fundamental premise that maybe something can start off as centralized and therefore be a security, but then evolve so it's sufficiently decentralized that it stops being a security. There's that general principle, which I thought was great that he said that. And then there's your point of, does that apply to Ethereum? Like, does the model he put forth actually apply to Ethereum? He may be wrong. You actually know more about this than I do. But the fundamental principle he put out there was great because it can be broadly applicable and apply to things beyond Ethereum.
Right. This was the exact statement. And putting aside the fundraising that accompanied the creation of Ether, based on my understanding of the present state of Ether, and a lot of people miss this part. Based on my understanding, this is an opinion, his personal opinion. Based on my understanding of the present state of Ether, the Ethereum network and its decentralized structure, current offers and sales of Ether are not security transactions. So it's basically his opinion. And as with Bitcoin, applying the disclosure regime, yeah. So that was part of the statement. So yeah, so a lot of us disagree with, the fact that Ethereum is not decentralized, and not to mention that it has other issues, but we can let it fail on its own. But anyway, we're not going to get into that here.
But you need freedom, Tone.
I think there's a whole backstory here between you guys and this freedom thing that I need to catch up on.
No, I'm just fucking with him. No, because it's the Tone hates Ethereum. Like, everybody who's watching knows that.
Yeah, I couldn't tell.
Yeah, no. But I actually think that the notion of decentralization, when it's not used as a marketing tool, is interesting. And there are certain technological applications where a decentralized system makes sense. I'm not sure I understand too big, Tone, like why a Bitcoin guy would be so opposed to the concept of decentralization. Are you just opposed to it because of the way it's been used as?
Oh, no. I'm not opposed. I'm not opposed to the concept of decentralization.
Why do you hate freedom?
No, I just think that it's a misconception that Ethereum is actually decentralized.
Oh, sure. Okay, yeah, no, I'm with you.
Yeah. So, for example, what Ethereum is trying to build is being built right now with the liquid sidechain on Bitcoin, which probably is decentralized enough for what Ethereum is trying to achieve. And a lot of people are going to say, well, that's because Tone is a Bitcoin shill and stuff like that. But no, it's because believing that Ethereum is decentralized when it isn't can basically create a lot of problems, like what happened with the DAO hack where they, return funds. And I think Ethereum is technologically unstable. Like, I'm just trying to help people to understand that, tying your wagon to Ethereum will probably lead to your downfall. If you're looking for decentralization, Ethereum is not it.
All right, so let me ask you this, and I don't have an opinion, I want to know your opinion. If the DAO hack happened today, two questions. Could they do what they did last time? Could they? Like, do they have capacity? And number two, would they? What's your point of view?
Could they? Absolutely. Would they? Probably not.
Okay. Now, okay, good, interesting answer. Now, so the could they is a strong argument that it's still centralized. What do you think has changed with the would they?
Oh, because it made them look bad afterwards. Like that. Like basically now the argument is that because of the DAO hack, they kind of proved that they're not decentralized. They kind of prove that they're centralized with the DAO hack reversal of funds. And if they do it again, they're just going to double down on the fact that they're centralized. So this time they're not going to do it again because they're not going to now the SEC will be looking at them very carefully if they do it again. But can they do it? Of course they can. Probably easier to do it now because those that opposed it the first time, left the project and, started Ethereum Classic, which had failed, right? So if anything, Ethereum is more centralized today. It's harder to have a node today than it was back then. Ethereum is even more centralized today, in my opinion, than it was back then. So can they do it? Absolutely. But this time around, they wouldn't do it. This time around, there's way too many eyes watching.
Okay, so it's interesting. There's the technological or the objective centralization, which is what you're talking about. We called out the Ethereum Classic people, and maybe it's hard to get a node. That's an argument that is sort of even if it was decentralized, re-centralized. But if there's a restraint on people's behavior because they don't dare touch it, because then it will cause it to become a security, make it more obvious it's a security, there may be some argument that people are truly being restrained, that it's not a security. It'd be interesting. It'd be almost good for Ethereum if there was another DAO hack and they didn't do anything. Like it would almost be, it's almost like what would happen with Binance when they said, quote unquote, they want to roll back the transactions, and then everyone said, shut up, we're not going to roll back anything.
Oh, no. This is the big difference, right? But what happened with Binance, like he can say whatever he likes. That wasn't going to happen. It was going to be impossible for him to actually do that. Like the fact that it was even brought up to me showed that the CEO of the company is grossly incompetent in his understanding of the Bitcoin blockchain to even consider it. Now, I'll give him the benefit of the doubt. Like if I stayed up for 72 hours without sleep, I may also say or think something stupid, right? So I'll give him a little benefit of the doubt on lack of sleep and stress. But if that was a statement that he said in a normal capacity, I would say this person has absolutely like this is a fireable offense. It's like the CEO of Amazon doesn't understand how Amazon works, basically, right? The CEO of one of the biggest exchanges doesn't understand how Bitcoin works. Right, so I'm not sure how, on that note, I'm not sure how Brian Armstrong has a job, which was going to be our next topic on exchanges, because he also doesn't really understand how Bitcoin works, but he still happens to be the CEO of Coinbase.
Can I ask you one more question? Yeah. If Vitalik disappeared and joined Satoshi on Mars and we never heard from him again, would you then say that Ethereum is now decentralized?
Perhaps it's now decentralized, but it would also be leaderless, and it will just fall in disarray. Like that. This is the problem, right? Like Ethereum, it would basically almost become useless. Like, and this is now we're getting into the technological problem with Ethereum, in that Ethereum would, this is the technological problem. Like, they can't scale, and they need Vitalik to kind of make these decisions. And if Vitalik is not there to make these decisions, like, Ethereum is going to fall apart technologically. So it's like damned if you do, damned if you don't.
So let me point out let me point out the problem with the SEC right now. What the SEC is consistently saying is that the platform needs to be functional and complete before the tokens are sold, or else the tokens are securities. That position is anti-innovation, because what it's making a whole bunch of companies doing, including some clients of mine or prospective clients, is pretend as if the platform is complete, or they need to act as if the platform is complete, because they start talking about roadmaps or future plans or how they're going to make it better over time. They're giving everyone else an argument that it's not complete. So this requirement that the SEC has is actually anti-innovation and it's anti-planning.
Well, wait a minute. I'm okay with that. I mean, look, you can raise funds through, without unqualified investors, right? I mean, how did any platform get funding to get built before, Ethereum? Like, I don't think this is anti-innovation at all.
With their idea that the platform has to be completely built before you sell tokens or else they're securities?
Well, when have you seen, well, sure, but like prior to Ethereum, when have you ever, sold, again, that's the security part of it, right? Like why does this have to change? Like this is kind of,
the better model would be sufficiently functional so that they're no longer securities. Like you can use it has its basic functionality, it works for its intended purpose, but you're allowed to upgrade it in the future. That would be a better standard.
Well, I mean, I'm just a simple country lawyer, fellas, and the Howey test has been around for a long time. It looks like that's pretty much what the SEC is applying. I don't think we see a lot of surprises there. I know there are folks who are interested in lobbying to try and get the law changed. If you listen to the PR from the Kick PR machine, apparently they say, they're going to go all the way to the Supreme Court to get the Supreme Court to modify that case law. I'm skeptical that will happen. There are situations where you can pre-sell things, and in doing so, the pre-sale is not necessarily a security. Obviously, our point here is not to provide legal advice, but I don't think that selling something that does not yet fully exist is a priori or always necessarily a securities offering. I think it's a little bit more nuanced than that. We could certainly debate policy and whether or not the 33 Act makes sense, whether the Howey Act makes sense. We talked about, I can't remember if we were on the air or not, but our friend Lewis Cohen, we were looking at his letter from DLX Law. Lewis, has asked in the past whether or not it might make sense for the U.S. to have more of a consumer protection approach to securities, like in other countries. So where you'd have a regulator like the FTC or comparable state regulators looking at fairness to consumers in connection with securities offerings as opposed to the registration requirements and regime that we have in the U.S. And those, like the Reg A Plus, I don't do that deal work. I know that's more your bailiwick. I handle the problems afterwards, but it's a non-trivial exercise to do a Reg A Plus offering. I think Blockstack paid, they said, $2 million in legal fees. Certainly we can imagine a regime where you don't have to do that, but where you still face onerous legal consequences for, selling shitcoins. You've got the Coinbase negligence suit up. I'd love to talk about that.
Yeah. Give me. Yep. We're gonna. I just want to make one quick comment. So just like in Blockstack and the other Reg A, this is the YouNow. And again, everyone is like cheerleading this stuff. Everyone in the crypto space is cheerleading this stuff. That this is like, a play for the little man. But if you look at this, right, like a lot of these, just like Blockstack, they pre-sold a bunch of these already before they even got the Reg A Plus, and they pre-sold them to Union Square Ventures, Comcast, Venrock. Like nothing has changed, guys. Nothing is going to change. The VCs and the already high net worth individuals and investors, they're still going to get there before you, right? Like it's
a lot of these things are totally undemocratic cash grabs, which are clothed in the language of freedom, and they're I don't love that, and I agree with you. It's all about taking money from the little guy to give to the big guy.
All right, so let's move on to the Coinbase case. I remember when Coinbase totally botched the whole Bcash fiasco. And I remember giving them hell for it. At first, I said they have to immediately provide Bcash to their people, and they didn't, and then decided to do it later, and then that became a mess. But this headline is very misleading. I'm like, wow, Coinbase must face negligence suit, but then I'm reading it, and it's like almost all the charges were dropped, and I still don't understand what they're in trouble for.
Let me explain why this case is important, and you should have my article up here.
No, it says send me the link. I didn't see yours because I read this and
I'm pretty sure that CoinDesk, and I like the CoinDesk people and I like Lee, but I'm pretty sure they got this because they saw my tweets about the case, which
this article made no sense at all to me. I'm sorry.
Let me explain why this case is important, and it requires that we understand a little bit of background about contract and tort law. There are basically two ways that we define legal relationships in U.S. law. One is you can have contractual agreements, like terms of service or a user agreement. The other is you can have tort obligations, like a negligence obligation. So for an example, if I agree to cut your grass or to shovel your walk and you agree to pay me $10, we have a contract, right? And I can use that contract to limit my liability to you for doing things badly or not performing. Like I can cap damages of $10 and so forth. That's like part of what you do in a contract is you try and, if you're the party providing services like Coinbase, you try and restrict the obligations that you have. There are also tort obligations, and tort obligations exist in the absence of a contract. So if I shovel my walk and I do it poorly and you slip and fall, you can sue me because courts impose in the US and in England and common law jurisdictions a duty to use reasonable care. Now, here's why this case is so interesting and why it is potentially damaging for Coinbase. Even though Coinbase had a user agreement, a contract that defined its obligations to its users, this judge said you can sue them for negligence, you can sue them in tort, because the court said that Coinbase had a duty, a tort duty outside of contract to maintain a functional marketplace. First, Coinbase encouraged traders to enter the market following its launch of trading in Bitcoin Cash. So Coinbase's actions were aimed at the traders as a class. Second, and this is wild, the negligent launch of a digital currency foreseeably impacts those who trade in the resulting dysfunctional market. Third, the buyers suffered an ascertainable pocketbook injury. And fourth, that injury is directly tied to the allegedly negligent launch. So the judge is saying, I'm not going to limit users to contract damages. I'm going to allow them to sue for negligence outside of the contract. Now, there's this thing in law called the economic loss doctrine, which is a fancy way of saying it's hard to sue someone for purely economic damages. It's also related to a principle that generally says that if you've got a contract with someone that creates your relationship, you usually can't sue them for things outside of a contract. This judge allows an exception. And think about that. Think about all of the monkey business on exchanges that we've seen in the last couple of years. Arbitrary delisting of assets, even some you don't like, wash trading, spoofing, exchanges allowing flash crashes to happen, exchanges freezing up and not allowing people to liquidate their positions in a run. The terms of service might say that your damages are restricted and that your liability is limited and that you're obligated to litigate in arbitration. This judge, this California federal court judge, says no. Coinbase has a duty to maintain a functional marketplace. And it's true, the court dismissed a fraud count, which was not a great claim, and it dismissed a state law unfair trade practices claim. The fact that the judge is allowing plaintiff to continue suing negligence, I'll tell you, as a lawyer, as a litigator, that's a really significant ruling.
Do you think it's right? It struck me as strange.
It's unusual. So one of the things that's strange about it is the judge said there isn't actually a California Supreme Court case on point. So it did something that it basically made an eerie guess. Like it guessed, it's a federal court sitting in diversity jurisdiction. And for those folks who are following along who aren't lawyers, federal courts that decide claims between citizens and residents of different states, in many cases have to apply state law under our federal system in the United States. Now, if state law isn't clear, a federal judge under a case called ERI will actually has to try and guess. So this judge said, I believe that if the California Supreme Court were to examine this case, they would find that this duty exists. It is weird if you understand the economic loss doctrine. It is really weird to do. Basically, what the plaintiffs did was they've torted a contract, is the way I look at it. Usually, like if my relationship with you is that I agreed to shovel your walk and you slip and you don't like the way that I shoveled your walk, you're generally restricted to suing me on the contract. If you sue me for negligence and fraud, I'm going to file a motion to dismiss and say we had a contractual agreement. You can't sue me outside of that. This case is like a really narrow exception to that. You'll also find an exception to it where there are professional obligations. So like you can sue a doctor or a lawyer or an accountant in some states for malpractice, and that can be a tort claim or a contract claim. So I'm just, but it's
if Coinbase, so I guess the argument is that they somehow acquired a duty to provide a functioning market. Is it their communications trying to convince people to use Coinbase for Bitcoin Cash, the thing that nailed them? Like if they had been silent and then they had this failure, would they then have been open to negligence?
So you can look further into so basically this is a ruling on a motion to dismiss. And for purposes of a motion to dismiss, the court assumes that all of the facts in it are true. So taken as true, the court says there's a claim here. This will be hotly litigated. My guess is Coinbase is going to appeal this. They have to, because it's bad precedent. So what the court said was the complaint lays out a plausible account that Coinbase breached its duty to maintain a functional marketplace. And the court explains what some of those factors are. Coinbase halted trading within 3 minutes of the launch is indicative of dysfunction. The buyers have also indicated precautions that Coinbase could have taken to avert the massive spike in the price of Bitcoin Cash on its exchange. It could have announced the launch of trading in Bitcoin Cash more than an hour in advance, ensuring liquidity. Coinbase instead launched trading while only purchase orders were pending. And the buyers have alleged a plausible motive for Coinbase's seemingly rushed decision to launch under subpar conditions. The Chicago Mercantile Exchange opened trading in Bitcoin futures the day before the launch. So the duty was created, I think, parsing this, the duty was created in part by things that Coinbase did that created an expectation among users. That's the way. So your question is, could they have avoided that?
By not creating the expectation, by just being silent and just implementing.
Well, I mean, I think the question is like, what does it mean to create a dysfunctional market, right? And I'm not sure if being silent would have. I'm not sure under this court's reasoning. I mean, we're in kind of uncharted.
This way, I think.
Saying, yeah.
You correct. I'm not a litigator. I'm just kind of shooting from the hip here. But I think that for the court to go beyond the contract, it's almost that the plaintiffs would have to have a reason to look beyond the contract when deciding what they can expect from Coinbase.
Yeah.
If Coinbase is creating this expectation by their marketing communications, the court goes, well, look, it's your choice. You decide to expand the purview of what you're offering or seeming to offer. Therefore, we can expand the purview beyond the contract to tort.
That's right. So basically, like, if you have a contract with someone and you want to sue them for fraud at the same time, you generally have to allege, unless it's like fraud in the inducement, you generally have to allege some conduct that is outside of it or exterior to the contract that's unrelated to the contract itself. Negligence is easier. Fraud is a little bit tricky. Like, there's no such thing as negligent. Generally speaking, like negligent performance of a contract, it's not a thing outside of the professional services context where you have a lawyer or a doctor. They've got basically a duty that exists in parallel. So I think that analysis makes sense. What's interesting too is, Tone, like I know you don't like Bitcoin SV, and maybe you think it should have been delisted. And I don't want to argue sort of the normative Should it have been or should it not have been delisted by what is it, Kraken and Binance? But
I think it should not have. I think that was just I think that is a I think that is a suable offense by people that want to trade in that currency.
This case actually potentially goes to that. You create a market, you create a duty to operate it in a non-dysfunctional fashion. If you list something and you earn fees and you earn trading fees, and then because you just bent out of shape, you remove it right away. Mike, I'm wondering if we'll see this case cited in cases.
That's interesting.
Yeah, you follow me?
You're saying that you even in the absence of creating a market, you have no obligation to create a market. But once you create a market, you create an expectation.
I think
and you suddenly delist. Are you not failing to follow through on the expectation you created?
I mean, there's an argument to be teased out there. Now, this case
there's an economic loss in the case of BSV when they delisted.
Well, I don't know, but I think this case, I think we may see it cited. I believe there is some litigation. I think maybe Silver has.
Yeah, I was just about to bring up Silver. He must be foaming at the mouth reading this because of his litigation against Kraken.
He did, yeah. He tweeted a little bit about it. I mean, it's a really, like, from a litigator standpoint, it's a really interesting case. I'm not sure it will be affirmed on appeal if it's taken up. It's a really, that notion, like, duty to maintain a functional market is a really interesting notion in the crypto space. So
I mean, in the market, that's gonna be tough. That also maybe supports the distributed decentralized exchange model, because if all of a sudden exchanges have a duty to maintain a functional market, I mean, can you, given the way that crypto works? I mean, given the liquidity.
Yeah, I think. I mean, look, I don't write software for crypto exchanges, so it's beyond, I suppose, what I can speak to from a technical feasibility standpoint. But I expect you can take some of the market surveillance tools, some of the software that's used in non-crypto exchanges, and implement those processes on cryptocurrency exchanges. And the answer might be, look, if you're going to be trading hundreds of millions or billions of dollars in assets and you can't maintain a functional market, then you should not be running a fucking market.
I'm with you. I'm with you on that one.
Like, make it work. Don't experiment on people's hard-earned money. Hey, fellas, I'm really sorry, but I got to jump. I've got to actually, I got to get ready to hop on a flight to someplace fast.
Pally, thanks for joining. I'm gonna throw my 2 cents on this after you get going. Hey, if you have like 30 seconds. Oh, actually, I was gonna ask you about that because I couldn't read that handwriting, but that's okay. We'll save it for next time.
No,
that is the real Satoshi.
Yeah.
Finally, he showed up, and his handwriting sucks.
Yeah.
I'll ask Gordon about it, but if you want to throw 2 cents in because you did tweet this out.
Yeah. So apparently somebody sent a letter to the court in the Kleiman versus Wright case. Basically, this is somebody who claims they have all sorts of information about the origin of Bitcoin. Did this person say they're a Satoshi? It's been a while since I've read this. I hereby certify I am the genuine and only original creator of the genuine work. Yeah, right. This person wrote a letter to the judge saying they were Satoshi, and I thought it was very entertaining. It's interesting. It was actually filed on the docket, and this was filed around the same day as the last Bitfinex Tether hearing in New York. And actually, can I say one thing about the Bitfinex business?
Oh yeah, please.
I don't want to go into the merits at all, but one of the things that drives me crazy that people don't seem to understand is that the New York State Attorney General has actually haven't filed a Martin Act lawsuit against Bitfinex or Tether. What this is, so people understand, this lawsuit I think it's still unclear, and it drives me a little bit nuts. This particular proceeding is an action to enforce subpoena in a regulatory investigation under a part of New York law that allows you to do that. I don't know if you've covered this in the past, but basically there's an investigation. The AG hasn't actually filed a Martin Act lawsuit. They actually haven't sued them, and Tether and Bitfinex are arguing that they don't, that they don't have to produce stuff, that they're not subject to the AG's jurisdiction. That's basically, like, it drives me crazy every time I see this. The procedural nicety.
My quick comment on this. So there is also, as part of the case and is in there, it's an email from the lawyers of Bitfinex that mentions my name, where the lawyer calls me a complete douchebag or something like that. I don't know if you saw that, Valley.
I did. Yeah. No, I was, I suppose, heartened and surprised that I didn't see one that called me that, because they didn't like me.
Yeah, but hey, so this is what I wanted to play. It's literally a 30-second clip. I always play it at the end of my shows before the lawyers leave. I don't think you've heard this one yet. I hope you can hear the audio.
Questions? Yeah, I had a question. I appreciate you guys making this happen and you being here, Derek. But the question I had, I've been going through ICOs and researching a little bit. And how safe are we here in the U.S. Not being an accredited investor investing in this ICO?
How safe as you or for us?
For myself.
You guys are fine. I think one thing I've learned a lot in the industry, especially since working in the finances, as long as the people make money, nobody complains. I got questions.
Well, that's interesting.
Who was that?
That was the CEO of Token Pay as they were doing their ICO.
Jeez Louise.
And he's an American with the ICO out of America.
Yeah.
There you go. All right. I think Drew is going to hop on in a little bit.
I'll let Drew take over for me. But lovely speaking with you, Gordon. Nice to meet you. And Tone, I hope to catch you again soon. All right?
All right. Thanks, Valley. Thank you again for joining us. Hey, Gordon, so I wanted to throw my 2 cents at it. So I remember what happened with Bcash and BCH. So Coinbase did not take the fork seriously when they should have. And therefore, they weren't prepared to split keys and give people their Bcash. So like 3 or 4 months later, they decided to finally do that. And pretty much at the same time, they opened up Bcash to actually be traded, because it wouldn't have made sense for them to open up Bcash for trading and not allow, because they're the custodian of people's Bitcoin, not give people their Bcash, but have it traded on their exchange. So I believe, so they kind of launched it at the same time. They launched trading of Bcash and giving people their Bcash. It was, so one of these lawsuits claimed that there was front running and, some people had advantages. They were able to trade before others. When this thing started trading on Coinbase, the value of one Bcash token went all the way to $8,000. Like it literally, that was
the good old days.
Yeah. So the Bcash token was, I think it was even like more than, not more, but like it was almost like 2/3 the value of a Bitcoin. And then everyone is like, holy shit, I'm going to go and sell it at this price. And then no one was able to do so.
Right.
And that's when they shut down trading of it. Now, perfect, Drew's here. And basically, like this is kind of how it stems. And I find this very interesting. And for the first time, I may actually, defend Coinbase here. I think this is kind of crazy, right? Because they tried to, I'm sure they're incompetent, right? But I don't know, but you can sue them for maybe incompetence. But they shut down the trading because it wasn't orderly. And now it seems like they're on the hook because they shut it down to try to do the best they can to make it orderly. Now they're accused of being negligent on doing that, which seems a little bit insane.
Hang on, Tone. You got one wire across there. If you look at the actual Burke order that I assume you're talking about, they talk about a whole bunch of things that Coinbase supposedly did, which gave rise, or which were evidence of, let me start over. They talked about things Coinbase did and didn't, and they talked about a bunch of things which they thought were not indicative of a functional market. The shutting down trading because things got crazy was not one of the things that the Burke opinion actually said was problematic. They said that was a logical and they intuited it to be a responsible thing for them to do. All the other things that were alleged that they did wrong, such as not announcing the listing with adequate time, not ensuring that there was an adequate number of buys and sells stacked up before they allowed trading to begin, that was all viewed as suggestive of a violation. But shutting the thing down when it showed that it was dysfunctional was not one of the things alleged to be indicative of its dysfunction.
Very good, because this article I thought was absolutely terrible, the way it explained everything. And it seemed like they dropped like all the stuff. So I'm still not. So
let me point one thing out, and I thought the prior comment was right on point also. This is not saying the plaintiffs are right. This is merely not granting Coinbase's motion to dismiss. Right? Now the real games begin. So they're just saying it's plausible that these things may be correct. It's enough that they should engage in discovery or get it from a jury and all that other jazz. So they're not, Coinbase is not being held liable. Now, as Stephen pointed out, even at this level, this may get appealed, but the judge is not coming down and saying that Coinbase is in the wrong. So I wouldn't assign too much meaning to this. I find a lot of these crypto publications tend to take a more extreme position than what the court's actually saying.
Yeah, I'm with you, but this is like Silver again. Silver is going to have a field day by ripping this apart and trying to take it to Kraken.
Look, Tone, Silver is going to take this and he's going to use it in every situation that he can against an exchange that has a contract that says that they're not liable to do X, Y, or Z. This is I don't know how much of the conversation we got into something very technical called the economic loss doctrine, but essentially, if you have a contract, it's very difficult to claim that you were harmed in tort because it's inferred that your remedies should arise in the contract, even if there's a tort. Mm-hmm. That's what allows people to basically limit their liability. What they're saying here is that under a law that, or a claim that is acknowledged to exist in New York, and according to the opinion, at least in some form, also acknowledged in, it's California and New York, there's this possibility that there might be this implied duty to prevent somebody from economic harm. What's more interesting about that is what this means for these sort of click wrap or browser rack agreements overall. Every time you use a website, you have to click on something that says, I agree to the terms and conditions of the use. And most people never look at this, but there's a 20, 30, 50, 100-page long agreement in there. And you really don't have much of an opportunity to negotiate it. You don't have much of an opportunity to say, I disagree with this part, but I like this part. And so I want you, website operator, to change your agreement. They're basically take it or leave it. And what this does is it opens up an alternative avenue for people to claim that, I clicked through the thing, but I was owed additional duties besides for what this agreement allowed. And this is very problematic if you think about the architecture of the internet. The internet relies on everybody to understand and to agree to certain things, like we're not liable if something on this website hurts your computer. We're not liable if you do things on this website and you're harmed in any way. And the people that control these websites use this as a way to allocate their risk. If we're now seeing some sort of secondary form of law emerging, or some secondary doctrine that says, yes, you can agree to all these things, and yes, you can try to limit your liability in these contracts, but we're going to put these other duties on you that you can't waive by contract. That's troubling, and that's concerning for the entire internet. It might be good for users of the internet, but it throws a lot of the certainty on the side of the website operators and those that maintain websites, kind of throws that out the window a little bit. So, or at least has the potential to.
Let me ask you a question, because this seems right up in your bailiwick. Part of the prior conversation that just happened with Stephen was the idea that Coinbase may have engaged in communications such as to provide a sort of a reasonable understanding on the part of their customers that they were going to do more than what they promised in the terms and conditions or in the writing. For example, they encouraged the Bitcoin Cash, and the users believed the Bitcoin Cash functionality was going to be there, and I guess created an expectation. I'm not going to use the exact language. And because they went beyond the words of the contract, because they they headed up into tort land, And my point was, if they had been silent or done better communication, they may not have been in this pickle. So it wasn't necessarily the failure of the market they provided, it's that failure combined with the expectation they created. And I'm wondering, number one, do you think that's possible? And number two, how does that mesh with the point you just made, which I thought was well taken?
So we're not having this discussion if Coinbase's arbitration provision is drafted properly so that arbitrability and the entire thing is being considered by an arbitrator, not by a court. So that's point number one. It seems like the court found that Coinbase did not draft the arbitration provision properly. Had they done so, we would have never been party to any of this discussion. And there's a side topic to go down talking about the perhaps negative impact of arbitration provisions in situations like this. But if I understand what you just said, Gordon, we're talking about whether there were other promises made separate and apart from the terms of use or user agreement that formed the core of this claim. And if there was a oral agreement that was violated, then we would be looking at an oral agreement breach. We wouldn't be looking at the implied duty, which is essentially what we have here. The court found that there was a duty that the exchange owed these people. Now, this is obviously on a motion to dismiss, which means the court says, you said the magic words and you made sufficient allegations of fact in a complaint that we're going to let you try to prove your case. It doesn't say it's proven. It doesn't say that there are sufficient facts to prove it. What it says is we're going to allow you to explore that claim because you have said things that under the law, if you can prove them, make you eligible to get relief.
Oh, this is going to be fun.
Yeah.
David. Oh, he's gone. He took off his camera instead of unmuting. I can unmute you, David. Oh, there
Drew,
you go.
where did you go? Yes, Drew. That was
You got to turn your camera on.
But he was kind of alluding to my point in a different way also, which is given the fact that the crypto market is infrastructure and logistics. Given that its infrastructure and logistics is not as stable or regulated or understood as regular securities, can you really form an expectation that these exchanges can process orders and maintain an orderly market under all conditions? I don't necessarily think you can.
So that's the real question, right? What is the duty go to? What are the parameters of that duty? Is it a duty to always have uptime? Is it a duty to behave like a SEC regulated national securities exchange? Is it some more general amorphous duty of fairness and transparency? This is, to my knowledge, sort of new ground, and the parameters of this, the outside boundaries of this, are going to be set, or would typically be set, by some objective standard of care and some sort of boundaries as to what this duty relates to. Does it relate to how people place orders? Does it relate to having uniform order types?
Right.
It's just not entirely clear right now. We have a lot of, there will be assuming that the case proceeds, there will probably be what's called a motion for summary judgment, where one side says, taking all the facts based on the application of the law, the other guy can't win, so enter judgment on my behalf. And someone is going to say, this is what the duty is. This is what the duty applied to. Here are the facts. I win or I lose.
Yeah, I think it's going to, I'm nervous, and you're alluding to this also, I'm nervous about the chilling effect that this can have on the development of exchanges. I think my personal opinion is that it's not a reasonable expectation yet for exchanges to be able to provide orderly markets and rational execution. They can't do things like front running, but I don't think they can be held to the same standard as, like you said, national security exchanges. And it's a growth period. And to assume otherwise, or to even hint otherwise, I mean, now there's another thing you have to think about when you're starting these exchanges, and the technology may just fundamentally not yet be ready. The one maybe flip side is, just like I think in some of the learned hand case, I mean, maybe if we're establishing this new standard of care, now the exchanges will raise their game because it's there in a way that they wouldn't have before.
Stop scratching.
With me?
Maybe. I think that we need, a lot more help. I'm gonna share my screen for just a moment so that everybody can see the Burke versus Coinbase case. This is the actual order denying the motion to compel and granting in part the motion to dismiss. And what you see here, I'm going to highlight the parts that matter here. They say that there's a theory of liability that Coinbase negligently launched a dysfunctional trading market for BCH. It's a closer question, but it's too collateral. But the claim is too collateral. The two is collateral to the user agreement. Even the plaintiffs could not access Coinbase's exchange without accepting the terms of the user agreement. Coinbase's negligence is actionable separate apart from contract.
Right.
As explained in the context of the motion dismissed, they bore a duty of reasonable care to its traders originating outside the agreement. And they cite to this Rice versus Downs case. And so then they say it's not subsumed within the user agreement. David Silver is right now doing backflips and, and probably in a state of consistent orgasm reading this.
Well, too much.
What he gets to do now is sue every exchange under theory. And when they say economic loss rule, go away, we have a contract, he gets to wave this order in their face, and then these claims get to maybe live to fight another day. Now, getting to what they're actually saying is going on here. They go through the basis of negligence, what you have to allege. There's a duty. The duty was breached. The breach of that duty caused the injury. That's basically American law everywhere you go. Coinbase here says that they contest most forcefully the existence of a duty, relying on the general rule that you don't have a duty to exercise reasonable care against the economic loss of others. The idea being that if you're in a contract with somebody and that party loses money, they have contract remedies, not independent negligence remedies. And so it says, to be sure, a duty to manage business affairs so as to prevent purely economic loss to third parties in their financial transactions is the exception, not the rule. They say here, California recognizes an exception where under 6 factors for establishing a duty to protect against economic loss: the extent to which the transaction was intended to affect the plaintiff, foreseeability of harm to him, the degree of certainty that the plaintiff suffered injury, the closeness of the connection between the defendant's conduct and the injury, and the moral blame. And so they say here, we've got enough alleged in this complaint to sustain that. They say that even though California courts haven't looked at whether exchange-trader relationship satisfies the test from the case that announced those factors, the Conja case, they say that they think the California Supreme Court would interpret it so that there was a claim there. Further down, they look at this case called In Re Facebook IPO, and they say that in New York, they found that the NASDAQ owed investors a duty to properly process orders. So reading between the lines, what they're saying here is there's some kind of duty to process transactions in an exchange. What they're not saying here is, are crypto asset exchanges anything like the NASDAQ? Are they subject to the same rules? And if they're not, where do we go to find our rules so that we can measure what these exchanges are and are not supposed to do? Now, there's objective fairness, and a court can certainly look at something and say this is fair or this isn't fair. And there are canons of construction and ways that courts can look at this. But what we're going to end up seeing here is more than likely what they call an interlocutory appeal, which means they're going to ask a higher court to look at this before they're able to proceed much further with the case. And I think we're going to see a bit more action there. Now, I know Mr. Silver is dying to tell everybody about how great his cases are now. He's going to use Trump word styles and sentence construction. He's going to tell us that other people have said his cases are great, but he doesn't know anything about that. David, take it away.
I love this stuff. This is great. Look, I mean, this is as, you know, I've got a 3-week trial coming up against the cryptocurrency exchange, and the phrase dysfunctional trading market is going to be used. It should be a drinking game how often. Because every single person moving forward, you know, every single crypto exchange case is going to be about whether there was a dysfunctional market. Especially think about, I don't want to talk about my cases because I've been told I'm egotistical. Let's just talk about what was going on in December of 2017 when no one could log into Kraken, Coinbase, Gemini, Poloniex, because everyone was so overwhelmed while Bitcoin was mooning. Think of all those people who didn't get their orders processed. This court basically came in and just said, all of those people have actionable claims. And what's crazy, if you were in Coinbase, you're going to be able to
go back and actually let's look at this thing.
Yeah, it was separate from their terms of service, so you'll be able to sue as a class action. And
but what they talk about, time out. What they talk about here is that it's not the buyers and the sellers that have the claim. They talk about a plausible account that they breached their duty to maintain a functional market. They halted trading within 3 minutes of launch. It's indicative of dysfunction. Okay. So if you're looking at this case and trying to figure out like what kind of evidence is going to get you past the motion to dismiss, here's an allegation of halted trading within 3 minutes. Here's an allegation that there were precautions they could have taken to avert the massive spike in price, that they could have announced their intent to launch more than an hour in advance, which would have allowed people to buyers and sellers to place their orders. They could have ensured liquidity. They instead launched trading while only purchase orders were pending, and they alleged a motive. None of that talks about uptime or downtime.
Well, we're now getting into, don't forget, this is a motion to dismiss. You have to take everything as pled as true.
Totally.
So, let's take a flash crash case, for instance, when there's a cryptocurrency exchange, hypothetically speaking, that allows a flash crash to allow liquidated margin sell orders while people can't access the system. And there's, communications of people saying, I can't get in. I think there's, going to be people in the height of the marketplace in December 2017 who are going to be able to show that they placed market orders that didn't get executed for hours or days.
Or, as we saw from the NYAG report, disappeared after the thing came back online.
Exactly. This is just going to open up a floodgate of litigation.
Get those notices of requests for judicial notice in before this thing gets appealed.
I can tell you under oath, I have filed under judicial notice this case already.
Okay, David, I'm not a litigator, so this is a little bit of education for me. My understanding is this is not an appellate opinion, right? And this
Correct.
Is probably in a different circuit than the cases you're talking about, I believe. So
you would be wrong. Gordon, I don't know you well enough, but you know what happens when you assume?
Yeah, I can ask myself, but fine. But this is not an appellate opinion, right?
Correct.
No, it's not an appellate opinion.
This is not binding. However, this is the first case to examine the issue, and it came out one way. So if you want to look at something, here you go.
And all the way, if you scroll up, Drew, you scroll up to the top, and I kind of made fun of Marco, who was downplaying this opinion. What makes this case really interesting is it's located in the Northern District of California, where 2 of the 3 largest U.S.-based exchanges are located.
So the comment that you were having an orgasm is, I guess, correct.
So it's not, I don't think it's going to be an interlocutory appeal. I do think Coinbase is going to appeal this. I made the point that when we beat Coinbase on the motion to compel arbitration, they did appeal to the 11th Circuit. The 11th Circuit ruled in our favor. I don't know how much of this is going to be, how much of this they're going to have an interlocutory appeal on to go up to the 9th Circuit. But I don't think the 9th Circuit is going to be particularly friendly to Coinbase on this particular issue. My presumption is they've rewritten their arbitration agreement and arbitration provision, and that anyone moving forward, this won't be an issue. But there's going to
be... Again, let's look at the footnote here. Subsequent remedial measures are not supposed to be held against you. Just because you fix something that was fucked up at the beginning doesn't mean it's to be held against you. The fact that they changed their arbitration agreement to make it better and not have this problem in the future isn't evidence that they did something wrong at the beginning.
No, my point was not that they did something wrong in the arbitration agreement. It's the difference of the arising out of versus under this agreement. They've now changed it so in the future, people won't be able to get out of the arbitration based on the language of the arbitration agreement in 2017. And it's good and bad. People like me, I don't object, and when people get confused often, I don't object to my cases being in arbitration. We talk a lot about the Michael Turpin versus AT&T decision case right now. And the Michael Turpin versus AT&T, where Turpin survived the motion to dismiss in California also, it's a good case, but I've got 40 of those SIM swapping cases in arbitration. Sometimes arbitration is a great and wonderful thing. I've got a case against a cryptocurrency exchange that's going for trial that's in front of a JAMS arbitration. The arbitration tribunals are just as good as courts sometimes. But what's crazy about this decision is just the language. and the language of crypto. This is what we've been talking about for years. It's a dysfunctional marketplace. I don't think there's a better phrase than that to describe what's been going on. And for all the people for years who said we were in this unregulated environment, look, it's not an unregulated environment. Turns out old laws are going to apply. And I think that's good for everybody. I think it's good that the litigation is going to move forward. I think it's good that we're going to hold these companies accountable. And I think it's great. This was a great decision. Is it going to, as Gordon points out, is it going to stand up to the appeal? I hope so. I can't swear to it. You know, appeals courts do weird things. This isn't going to be a Supreme Court decision. This is at most going to go to the Ninth Circuit. I don't see the Ninth Circuit overturning it. But, you know, until there's a split in the different circuits, the Supreme Court rarely on topics like this will weigh in on something if there's not a split in the circuits.
So because really quick, because this was a federal court guessing about the way that a state court would implement state law, they would technically send it to the Ninth. The Ninth would then send it over to the California State Supreme Court. What they did is called an eerie guess. They said basically, we're guessing the way that the state would implement its law. And so this would go up and over to the California Supreme Court, who would then say, yes, we would recognize this cause of action or not. And then they would take it back.
Well, it's not a cause of action they're recognizing. I mean, for it to go through that analysis, a lot of different things would have to happen. I think that it's more likely than not the Ninth is just going to, you know, not even do a full opinion on this. If, and again, it has to be when Drew's talking interlocutory appeals. There are only so many types of decisions where you can appeal it while the case is going forward. And I don't believe, and you know, this is more for Drew than me, I don't believe this exact topic is an interlocutory appeal. If it was the motion to compel arbitration only, the motion to compel arbitration could go up. I don't know if this particular issue can actually go up to the Ninth right now, or if they actually have to go through the whole case and then take it up on appeal.
Hey, quick thing. Adela commented, David, can you just explain to the people what a judicial notice is?
So judicial notice. So basically so I'm going to use BitConnect because a lot of people on here know what BitConnect is. BitConnect is a big lawsuit that's been we filed a lawsuit against the bad guys. The motions to dismiss were filed like a year ago. So the entire case is fully briefed. All the lawyers have written their memorandums of law. When something new comes out, you file with the court what's called judicial notice. You tell the court, look, we've already done all the papers, but we want you to look at this decision. And here, everyone's rushing. All the plaintiffs' lawyers are rushing to put this decision in front of judges, whether it be it doesn't have to be limited to California. As Gordon and Drew were saying, just because a decision comes out doesn't mean it's binding. Here, we all rushed out and we said, judges, look at this. This decision just came out and it's holding a cryptocurrency exchange liable, which, you know, it's not really holding them liable. It's saying there's a potential to hold them liable. But you use a decision that comes out after something's fully briefed and you ask the court to take notice of it. So for the judicial notice is just a way of getting a new case in front of a judge. It's not really that exciting.
Yeah, so another way to say it much more simply, and Silver, you're not on your game today. If you want to show the court something that you think is going to help them make the decision that came from another court, you can file it with a piece of paper that basically says, hey, judge, look at this too.
Keep it simple, stupid. Drew nailed that one out of the park.
There you go. So to answer your question, let's get super technical for a second. It's an issue of a 1292, whether it is reviewable as an interlocutory appeal. There are some circuits do allow you to appeal this as an interlocutory. So in other words, we might see this appeal now, and we might see it in like 2 years.
Yeah, it's a weird decision because it's split, because it technically denied the motion to compel arbitration, which is appealable.
Right.
So I don't disagree. And Coinbase did take up to the 11th that issue with us. But again, they lost. So that case actually, you know, it's going to get some nice press in a couple of weeks when the motions for summary judgment and the motion for certification, class certification become public. They were filed under seal temporarily last week. but that's actually all going to come public soon. And it's going to be interesting because, again, what happened on these cryptocurrency exchanges in 2015, 16, and early 17 are very different than what's going on today. And, I think some people are going to be shocked. I think the shock value of what was going on back then for what people perceive to be legitimate exchanges is going to shock the conscious, as I like to say.
David, let me ask you a question. The recent, not the second, but the recent run up in the price of Bitcoin, where everyone tried to dump it around 13,000 and Coinbase froze up, if you recall. What's your take on that? Last month.
So I typically tell people I don't do lost profit cases. It's hard to, say I was going to sell at 13,000. I didn't get to sell at 11,000. So typically those aren't the cases I file because lost profits are almost impossible to prove. If there was a class action and class action was available to people, that'd be different. But so far, while the courts have upheld the right to sue under certain circumstances, Coinbase and other crypto exchanges, they've found the terms of service to be unconscionable on more than one occasion, but they haven't allowed the class actions to go forward. So in order for something like where, Coinbase froze when it was peaking at 13,000 and then immediately dropped down to like 11,000 and you lost 20%, those are great cases on class actions, but it's virtually impossible to find someone who can prove that they lost a couple of $1,000,000 on the individual basis. You can only do that type of lawsuit in aggregation. And we still haven't seen anyone come back and try and do a class action. I mean, Burke is technically a class action. So it will be interesting, whether or not Coinbase, who is fighting to do the motion to compel, we haven't done a motion for certification yet. I mean, that's a whole other battle. Right. That will be interesting to see if they can get certification on this. So the class cert is an interesting issue on lost profit cases because you need to aggregate as many people as possible.
Wait, are you currently suing Coinbase as well, David?
I am the only person right now who has a class action against Coinbase. This will be the second one, Burke, but Lidell v. Coinbase is the class action from the Cripsey case. That case is now
that's right, the Cripsey case.
Yes, that Lidell v. Coinbase is briefed on the motion for class certification and their motion for summary judgment. And I'm going to start, those papers are going to go out in redacted form shortly. And again, it's going to be very interesting for people who were in crypto in 2014 and 15 to read what was going on at Coinbase in that time frame.
You're welcome, David.
All right, guys. Hey, let's stick with the exchanges a little bit. I don't know how much we want to get into this, but God, the amount of countries and cases piling up against the former owner of BTCE for all this criminal and money laundering stuff. Anybody up to date on this case? I mean, at this point, it doesn't matter if another country is trying to sue him for 100 million, right?
So look, this Vinnik guy is a Russian national who was in Greece. I think he's still being held in Greece. BTCE had zero AML KYC, and it's alleged to have been the place where Vinnik laundered most of the money that either he or other people stole. I forget the exact allegation from Mt. Gox. Right. They already have an action against BTCE for criminal relief. And so then they file the civil suit, and that probably allows them to get money relief that's separate and independent from the criminal charges as well. I think it's important, but I don't think it's adding much from to the prior lawsuits.
I think the only thing it changes is I would be terrified if I was a U.S. citizen living abroad right now, running a cryptocurrency exchange that didn't do KYC. Oh, look at that headline.
Doesn't even matter if you are a U.S. citizen. They can reach out and touch you if you want.
Yeah, but it's hard. It's easier to get people who are actual U.S. citizens. I mean,
whenever I'm doing presentations, I always call it, whenever you think you're going to get away with stuff, just remember Noriega. If they really want to get you, they're going to get you.
Totally.
All right, so David, go on. You weren't on the show last week where we discussed this story, but give us a few words on what's going on here.
I think, I've been a big proponent of the fact that people who want to keep their U.S. citizenship and want to be able to come back to the U.S. and want to be, and want to run these crypto exchanges. I can't really talk about BitMEX specifically, but anyone who fits that bill, who is laundering money and can't show who their clients are and can't show KYC and has millions to hundreds of millions of dollars running through their business, and
you forgot the word allegedly.
Allegedly running through their business.
That's better.
It's problematic. The statute of limitations is going to outlive most of these people.
So here's the big.
So the moral of that story is give up your U.S. citizenship.
Moral of that story is live in some place that has non-extradition.
Well, wait. The prior story. I mean, he's a Russian national. He has nothing to do with the U.S. Probably never been.
I was obviously being sarcastic. The moment you're, in real life, the moment you're hurting grandma in the U.S. or working against the U.S., the moment that is the slightest little nexus, and a nexus can be an electron passing through a network that happens to hit Guam. Okay, there's personal jurisdiction, and you're nailed. Right, and by the time I knew you were gonna jump with that. But here's the thing: in practical terms, by the time you're done arguing, okay, you've lost everything. You've gotten divorced, and you've been stripped of your assets, even if you win in the end. Okay, that's the kind of practical thing I tell my clients. Yes, obviously. I mean, with Liberty or whatever that coin was that predated, Bitcoin. The guy I think he quote unquote won in the end, right? But he had no assets, no marriage, and he was destroyed. So just the real life thing is just remember Noriega. If you're hurting American interests or American, especially Main Street investors, and you're doing anything that seems to support criminal networks or terrorism, you're in the crosshairs. That's just reality, and it doesn't matter if you're in Belarus.
This one's pretty simple. Statute of limitations. The government takes its time, but I am going to expect to see a lot of people get in a lot of trouble for what they've done.
All right. So,
actually, Tom, can I ask David? I've been going back and forth on this myself. So, yes, the DAO report came out and it acknowledged the obvious that some tokens are securities, obviously. Do you think that the non-fraudulent but non-registered ICOs that happened prior to the DAO report, do you think there's going to be any fallout, or do you think they're getting a pass?
I think that the government is a blunt force instrument, and they're going to go after some of the biggest targets. I can personally confirm that the SEC and the CFTC are still investigating some of the earlier ICOs who think they've gotten away with their crimes. I can tell you from personal experience, having spoken to them as recently as last week, they are slowly but methodically going after investigating different people and entities. And I think that I've said it, yesterday's heroes are tomorrow's convicted felons.
Okay, now, so Drew, what do you think? Pre-DAO, non-fraudulent ICOs, do you think that there's going to be consequences?
It's really difficult for me to wrap my head around that question because you said two words that don't work together, which is non-fraudulent ICOs.
Yeah, I was going to say that too.
Well,
if the question,
let me say
the real question is
non-registered, but no material misrepresentation of fact other than possible security status. But like
I think what you're really asking me is there a magic line where if you're before the magic line, you're getting a pass? I think enforcement activities so far have made a point to say that a certain amount of violative activity happened after the date of the DAO report, if memory serves 6/25/17. And that's all well and good. It does not mean that, in my view, you should read it as a pass for people before. As David suggested, I'm not surprised at all to hear that some of the larger raises prior to that date are being looked at. And as we saw from the Kick complaint, the SEC has no problem going after folks for violative activity, and there isn't a scienter or a specific intent required to bring an action for failure to register 5A. So, you know,
Drew,
so
I
far
was
we haven't
impressed.
seen. You like
Drew, I was
that?
impressed. July 25th.
July 25th. My bad.
I mean, I'm not arguing that they were illegal. I'm asking a question without assuming an answer, which is
Yeah, I don't think there's a magic line where you're home free if you were before that date. I think that it's probably easier to get a settlement out of folks if you can show them that they should have been on notice because of the published 21A report.
Mhm.
And I think that's why they've made it that's why they've noted that in all of those stipulated consent orders that have been substituting for guidance in this area.
Mhm.
I don't think it means by any means that people who were before that date should feel any more or less comfortable than anybody else.
Yeah, I can't tell you exactly what it was, but when was Tezos? Wasn't that technically before July 25th?
I don't know, but I'm waiting for them to buy a country.
Well, she's giving all her money to charity. God bless.
All right.
All right, guys. Hey, unless someone wants to say a comment about the whole Bitfinex versus Tether issue, the only other topic I have is the tax issue is coming up again. And Drew and Carlin Fields, you guys published something about taxes on your site. So unless someone wants to jump in about Bitfinex and Tether, let's talk about the whole tax situation a little bit. I know you guys aren't tax. I should have like a tax show coming up towards the end of the year. But Drew, you want to talk about this a little bit before you have to head out?
Sure. I've got about 10 minutes. So let's spend 5 minutes on what you've got up, and let's spend 5 minutes on the educational notices that have been circulated to various people in the crypto world.
I believe we're talking about this.
Yep.
So the IRS sent 3 different forms of letter to about 10,000, or the IRS has said they intend to send one of 3 different forms of letter to about 10,000 different people, essentially saying one of 3 things. We think that you haven't reported your gains and losses on cryptocurrency, and we want you to either amend, file your delinquent return, or sign this document under oath and send it back to me saying that I agree that everything I've done is proper. That's one version. One version says you might have had assets in an account that you didn't report. Here's a summary of the guidance. And a third version says you might have had transactions that you didn't report. Here's a summary of the guidance. And what that says to me is, and this is just sort of my informal assumption, not based on anything that I've read or know personally, but that number 10,000 is really interesting because the John Doe summons served upon Coinbase yielded 14,356 sets of records for people who had done transactions of 20,000 or more between 13 and 15. During that same period of time, 802 American taxpayers filed tax returns disclosing gains or losses of for crypto assets. So if you are any good at math, there's about 13,500 people who probably had taxable events that they didn't report during that time period. Could be that those about 10,000 are those Coinbase folks that didn't disclose, and now here's your chance to like kind of get right with the Lord before the fire and brimstone comes raining down upon you. Also, if you look at the bottom of the release that the IRS said about this, they said, oh yeah, and we expect to have some new guidance out soon. It would be great to get that new guidance out. Anytime that y'all are ready at the IRS, we know you work hard, we know you're understaffed, we know you're underfunded, we know you're still digging out from the 2018 bill that was dropped on you with basically no consultation, but we're ready. Help us. We need this.
All right, well, one second. So before you talk about your article, speaking of underfunded, as you just said, I'm sure you guys seen this where they're claiming that they're actually going to be, scraping the history of the internet and investigating people directly based on their social media. How is that possible? And how are they going to get the records from Google and Apple and text messages in a blanket? Like, we're going to get everybody's information. How is that even legal for starters? So
they did it through a John Doe summons to Coinbase, which is, we think that there's information here related to tax evasion. Here's an affidavit from an investigator. here's our evidence. When you go in and you establish the minimum required, you're the IRS, it's pretty much a layup. Then you get what Coinbase did, which is mobilize a bunch of loyalists and have them and protest and say, basically, this is overbroad, this is too burdensome, and then you narrow it. Now, they need to have some way to go to like Google or Facebook and say, give me everything on this. And those companies are certainly going to push back and say, maybe you need to narrow this and make it a little bit easier for me to actually find the responsive documents. If I'm those companies, that's probably the way that I respond to it. I have no knowledge of any of that going on in any of these companies, of course.
Yeah, I mean,
but the other thing that's interesting about those IRS slides is look at those.
I know they're terrible.
Those are pretty rough.
This is a little different though. It is a little different. I mean, what Coinbase did, and everyone knows how the Coinbase case played out. Coinbase spun a win for their clients by saying, we only had to produce like 10% of what they asked for or less. Well, it turns out that was because they only had to produce accounts that traded in excess of $20,000. So
no. Accounts that had a trade in excess of 20,000.
No.
No. I think it was total.
It was an aggregate.
Okay.
And that yielded the 13,000 that Drew's talking about, as opposed to the 2 million accounts there. So they did get to slash it down, but the U.S. government really, this is tax purposes, and this is going to be the easy way. This is how they got Capone. They got Capone with the taxes.
Yep.
So of the 13,000, what I find really interesting is there are people that, first of all, I find it amazing that only 800 people in 15 and 16 reported gains or losses on their tax return. I have personally sent several people to large law firms in DC because they had multi-million-dollar transactions each year on Coinbase, and I have told them, and I give everyone the same legal advice. Go hire a really good lawyer in DC who's going to work with the IRS and report everything. If you did the transactions on Coinbase, you're done. There's not going to be any type of, ooh, I didn't understand, I didn't do. They have your records. Come up clean now. If you don't have the money because you blew it all, you didn't. The IRS is very lenient once you get your corrected tax return. They're going to collect, but they'll collect $1 a day for the rest of your life. It's the people who think they're going to get away from hiding it that are going to get in trouble. They have the records. And by the way, I'm obviously an advocate of, regulators, intervention, and doing all these sort of things. I have no issues. If I buy or sell stocks, I have to, the trading firms and the broker dealers have to report this. The exchanges have to report this too. Everyone should be paying taxes on this. If you want this to be a mainstream system and you want Bitcoin to go to $1 million each, this is good for crypto.
Let me point out one thing. I think I agree with what you're saying. I think there's also, Drew, I would like to have you comment on this. I think there's also a nugget in the guidance or the letters from the IRS where they're saying that crypto to crypto transactions are not like-kind exchanges.
Yep.
And the gain or profit is realized at each transaction, not once converted back into fiat. Do you agree with that?
That's true.
Yep. There was a suggestion in 2 of the 3 versions of the letter that I mentioned before that were sent to these 10,000 cryptocurrency holders that suggested that the 1031 exception, which calls for a deferral of the tax basis during a transaction, I'll explain what that means in a second, does not apply to cryptocurrency. We know that from 2018 because the tax bill expressly changed the law and it narrowed the class of assets that qualified for a 1031 exception to real property, meaning dirt, and improvements on dirt only. The 1031 exception is something that we got in the 20s in the tax code because people were not selling real estate. The problem they ran into is that they bought a piece of real estate, they paid off the mortgage over 20 years, they depreciated it down to 0, they were making rents, and if they sold it, they would have had a massive capital gain bill. And so people were hoarding real estate, and we don't like that. We want people to redevelop real estate. We want people to sell real estate. It's part of what makes our country work. So they made this law that says if you have an asset you bought for $10, it's worth $10,000 when you sell it. If you sell it for another similar asset, meaning another piece of real estate, you can pass the potential gain exposure on to the next piece of real estate. This allows these assets to flow freely. The government has no policy that says they want you to trade a heavily upvalued Bitcoin. That policy doesn't exist. They don't care. It doesn't apply to things like stocks and bonds because they don't care if you have a highly appreciated stock. If you made a whole bunch of money on it, they want you to pay your taxes. The policy that calls for us to make sure that heavily appreciated real estate continues to trade doesn't apply here. The other reason that even before 2018, it probably would have never applied is that a 1031 exchange isn't simply, I traded a Bitcoin for an Ether, so I don't have to pay taxes. You have to have an intermediary. You have to have a kind of intermediary called a qualified intermediary. The qualified intermediary has to comply with state law and in some states even be licensed. It has to have an insurance policy. It has to be arm's length from both parties. There has to be a contract. So there's a lot of formalities and there's a time limit, although it's not really a huge deal in crypto land because most crypto exchanges are substantially contemporaneous. In a real estate transaction, I think it's 45 days.
Yeah, right. And one last nugget on that, and since Drew over-explained, I haven't been here a lot lately, just take it from this. The same people who told you there was such a thing as a utility token were the same people who told you can do a like-kind exchange. It was never going to happen. The IRS was never going to allow it. And it was a crock of shit back then, and it's never going to be.
David,
so I guess we shouldn't care about.
Go head-to-head with you on utility token.
Well, everyone's entitled to be wrong. My wife tells me that on a daily basis.
So I got to run, so let's make this real quick. But Gordon, I did go back and read the Foreman opinion recently. Here's what's interesting about the Foreman opinion. That's the recipe for the token that the SEC wants you to issue now. Everybody read it, they saw what the Foreman instrument was, and they said, oh, cool, we can have securities that aren't really securities. Had they read Foreman and saw what the stock was in Foreman, they wouldn't have made half of this nonsense that got sold. They would have made the same thing the SEC wants you to make right now. That's Tone, write that one down. Me and Gordon will debate about Foreman at another time.
I would love to. Actually, we should have that, Tone.
But I got to roll.
You have to do two debates. You have to debate silver on a utility token.
Fine. Well, listen, we'll do a three-way death match.
No thanks.
All right.
I'm good. Tone, you want to talk about this thing real quick?
Yeah. Drew, comment on the article that you wrote, and
Sure.
And then we'll let you go.
All right, great. So we actually published a 3-part article series about a case called Wayfair. The big internet retailer Wayfair got sued by the state of South Dakota. South Dakota wanted to collect sales tax. The rule from an old case called Quill said if you're not incorporated in the jurisdiction, if you don't have people there, if you don't own property there, it doesn't matter if you sell remotely, the state can't collect sales tax. They overruled that, and they introduced something called an economic nexus test, which said if you sell enough as far as the number of transactions, or if you sell enough as far as the amount of value into the state can start to assess sales tax. So far, so good. Recent laws have tried to kind of accommodate for the fact that we're really talking about internet transactions. And they looked at things like Amazon and eBay and Etsy and Spotify, and they saw that most people don't make their own website. They make a little shop inside somebody else's marketplace and they borrow all their infrastructure. And so these laws now have this concept of a marketplace facilitator, which is the eBay or the Amazon, and a marketplace seller. That's the mom and pop that sells, hats, whatever they sell. And so the law requires that the marketplace facilitator collect the sales taxes owed by the marketplace sellers, remit on their behalf, which means if you're the state of New York, you're collecting against Amazon, not against all the mom and pops that sold sufficient numbers or amount of value into New York. So far, so good. What the hell does this have to do with crypto? Well,
the idea ICO exchanges. I see where this is going.
So there's 3 places this could potentially touch us. The first one is I sold a token and I'm going to make a marketplace and everyone's going to buy and sell stuff using my token on my marketplace as the friction instrument. Those marketplaces might be viewed as the marketplace facilitators, and they would have to collect and remit sales tax from the sellers who use their platforms. And they would have to do so in terms of US dollars, which means there's going to be all sorts of tomfoolery with respect to conversion. So that's number 1. Number 2, what about Polo? What about Poloniex? What if Bitcoin and Ethereum are both commodities? And what if I'm on Poloniex and I'm selling a whole lot of Bitcoin to a whole lot of people in New York? At a certain point, if I've done 51 trades or $1 million worth of trades, maybe I'm a marketplace seller, and maybe Polo needs to reach out and collect sales tax from me on all of my transactions. Okay, there's a lot of nuance to this. Each state has different definitions of what kinds of products are retail products for which they can collect sales tax. However, depending on the nuance, and there is not yet uniformity in these state statutes, it's entirely possible that an exchange may be subjected to collecting sales tax from its traders and remitting it. Remember, these things aren't securities, they're commodities. So this is as if I'm selling cans of coffee or oranges or, or pork bellies or frozen concentrated orange juice. Okay. The third one, and this is the one that Tone will enjoy the most, is Ethereum. Okay. What if every time that I bought an ERC-20 token, every time I sold an ERC-20 token for an Ether into a certain state, that was the sale of a retail good, right? It's a utility token, according to Gordon, which is not a security. It's a commodity. It's frozen concentrated orange juice. So I sell 50 cans of my frozen concentrated orange juice to somebody in New York on Ethereum. Does the Ethereum system have some sort of obligation to collect sales tax and remit it on my behalf? Who on earth within the Ethereum Foundation or the Ethereum system or the miners or the node operators could actually do this? Same thing if you're selling ERC-721 CryptoKitties. By the way, same thing if you're offering smart contract execution services, because it may be a taxable sale of a service. And we can look at a whole bunch of interesting precedent as to the taxation of, say, pay-per-view events to look for precedent under the tax laws there. And so that's sort of the a really quick overview of the crypto aspects. There's a third element of this that looks at it applied to online gaming. Think about loot boxes. Think about reselling skins and armor and weapons. Think about distributing video games online. It could be that buying and selling these online instruments or skins or power-ups to your character may also subject you to the publisher or the operator of the game having to actually collect and remit sales tax. So if you're interested, or if anything that I said made no sense to you, or if I really pissed you off because I killed one of your sacred cows, read it. Let me know what you think. Would love to hear from you.
All right. Thanks, Drew. I'll let the guys comment on it. I know we have to let you go. And all these links are, of course, in the video description. I'll jot down the debate you and Gordon will have on a future show. Thanks for joining us, Drew.
All right, guys. Good to see you all. Thanks, Tom. So long.
Okay, man. You got me for like 3 minutes. Any last questions for me?
No, that's it. Unless you want to throw something at him. I don't have anything more for Silver other than the usual question: who are you going to sue next?
I got some interesting cases going to be filed in the next 2 weeks. I got final pipelines with people handing out. I think you're going to like a couple of them. We're shifting to fake traders, for what I like to call fake promoters. It's promoter week. We're suing a ton of promoters. Another lawsuit that's coming out in the near future is we're going to sue one of the larger, what's the word I'm looking for? It's not seminar, conference providers who promised prizes and never delivered. I think we're going to get
that's going to get interesting.
We've got some interesting ones coming out. The SIM swapping cases are moving through the process. I've got 40 SIM swapping cases right now. The SIM swapping cases are crazy.
That happened to me 3 times. They've never gotten to anything. I learned my operational security inside and out.
There you go.
It happened to me once.
Me, Tony, on with you. Happened to me once.
Yeah, it's happened to Leah like 2 or 3 times already.
It's crazy, and
and it's insider, as you know. It's
at $200 a pop. It's not even like they were getting paid big monies for this.
I know, it's kind of insulting how little these insiders got paid to like.
Yeah, considering someone got Turpin for like 100 million.
Yeah, but they probably held the coins. They probably were holders.
Yeah.
It's 24 million now, worth less than 100,000.
Yeah. Oh, okay. So David, before I let you go, you've heard our Moment of Zen at the end of the shows before?
Yeah.
You've heard this, right?
No.
Oh, okay. This is our Moment of Zen at the end of the show. Drew's heard.
Questions.
Yeah, I had a question. I appreciate you guys making this happen and you being here, Derek. But the question I had, I've been going through ICOs and researching a little bit. And how safe are we here in the U.S. Not being an accredited investor investing in this ICO?
How safe as you or for us?
For myself.
Oh shit! I'm so sorry. I forgot to share a screen. My bad.
Yeah, I think we're missing like his happy little face.
Yeah, right here.
ICOs and researching a little bit. And how safe are we here in the U.S. Not being an accredited investor investing in this ICO?
How safe as you or for us?
For myself.
You guys are fine. I think one thing I've learned a lot in the industry, especially since working in the finances, as long as the people make money, nobody complains.
I got questions.
So that was a U.S. citizen promoting an ICO into its sale a few years ago.
You know, I've seen that video before, so I've clearly either saw it on your show.
Oh, yeah,
About that video is the guy somehow was able to afford an expensive office chair. Look, you know, I did a breakdown on Twitter of the kick answer, and the problem is that they're trying to defend statements that he made, that he believed while he was saying them, and that's it's the biggest secret in Washington D.C. You get in the most trouble for telling the truth. And you know, and the defense was, look, we made millions of statements. Are there 3 statements that, if you take out of context, look pretty bad? The answer is yes. So yeah, I think most people told everyone their ICOs were going to make money, and they were all getting Lamborghinis. But call me crazy.
All right, we'll let you go, Gordon. Unless you have anything else to ask David, we're probably going to wrap the show up. And
I look forward to the utility versus other death match or blood sports, but now's not the time.
Sounds good, man. Have a good night, everybody.
It's a pleasure. You're a good guy. It's interesting.
Enjoy.
Thanks.
All right. Yeah, thanks for jumping on, David. All right, Gordon, I'm going to probably let you go as well. And anything else you want to talk about real quick? Anything else that interests you in the law? Floor is yours. I think we covered everything I wanted to cover.
I am watching avidly Libra happen/not happen.
Libra,
and
yes.
There was 6 hours of testimony and I don't have it on my fingertips, but there's 6 hours of testimony by the head of Libra in front of the House committee with Maxine Waters and the rest of them. And there was, you know, it's kind of touch and go, and it's interesting. I think there's a decent argument that Libra may be beyond the application of current U.S. law. And by looking at the structure and how he's speaking, and this is probably a separate video, but looking at how he's speaking, I would love to know who the lawyers were, because I think they quite intentionally threaded the needle before this thing was ever announced. I think that they're a little bit surprised at the level of pushback from the U.S. But I saw something just that blew my mind. I don't know why other people aren't queuing in on it. The letter from the House committee to Libra saying, pause, let us hold hearings. It wasn't just Facebook, we don't trust you because of Cambridge Analytica. They said something just amazing, which is Libra has the possibility of undermining the US dollar. Okay, that is true. But the fact that the US government would admit that a corporate crypto or a corporate digital currency could even have the potentiality of undermining the US dollar was a huge admission of the vulnerability of the dollar. Because what happens when you start having nation states backing crypto with their resources and their jurisdictions? I mean, to me, it kind of showed the teetering status of the US dollar. And so it's, you know, I don't know if they're going to fully admit what's going on, but that was a pretty intense admission. So I'm following Libra very closely. I'm also looking at the potential competitors that are rising up against it. There's Antonopoulos did an interesting presentation. I think it was an hour long, where he we may be heading to sort of a global corporate feudalist type world. I mean, if all these corporations are issuing their crypto, sorry, if all these corporations are issuing currency, and currency stops being a function of government, but is not a function of a decentralized network, but becomes a function of companies. That's, I mean, we may be moving into the postmodern period. It's an interesting time.
Yeah, no, stay on top of the whole Libra situation, and it'll definitely come up again as a topic on the show.
Right. Well, what's your impression of Libra, dare I ask?
That's the thing. I mean, to me, you and I debated that statement, the thing that you just said about, U.S. government admitting that their currency is so vulnerable to the currency of Facebook. And I just thought that it was, statements of like one lady who I know you think she's a lot more relevant than I do. I mean, I just hate the fact how they stick these congressmen on these committees, whether they have any kind of, expertise in the subject or not. Like, I would love to know what Maxine Waters, expertise is in finances, because she's the head of the financial committee, right? Like this is the part that really drives me nuts. And like I said, to me, I need to see that statement from the Treasury Secretary, from the head of the Federal Reserve. I don't really care what some senator that probably has never taken a finance course in her life says when regards to, this undermines the US dollar, because I don't believe that it actually does, but that's also my opinion.
Let me be clear, she does not have a lot of, I have not been impressed by her prior statements or her positions on crypto. She's a little bit like Elizabeth Warren, but maybe not even at that level. But it's not like she was the one drafting this letter. It was probably, this is a powerful committee with staff. And this is a public-facing document. I give it a little bit more meaning than you do. It wasn't just this office of this one person where she was up late and decided to write it out. And we're also seeing, I think, Chairman of the Federal Reserve and Secretary of the Treasury make comments about Bitcoin and crypto that are beyond the normal AML KYC concerns. They're beginning to allude to the fact that it may pose systemic risk. And maybe I'll gather some of those together and we can talk about it. But it just the mere fact that even the tip of the iceberg came out a little bit is just a phase shift that I find interesting. But we'll go into it.
Yeah. People are asking about the whole Bitfinex and Tether thing. We're gonna talk about it later. There's just not much to talk about. We don't know, nothing's been going on since the whole thing was filed. We just have to wait for more clarity on that. But right. So my view on Libra is, look, this is an attempt by a corporation to establish private money. But it's not really private money, because the underlying of that private money is still government public money. So it's like quasi-private money. They just control the gateway of transactions, and they control the stability mechanism. But if the government walks into, Calibra's office and tells them that they have to change the stability mechanism, they probably will. Like if the committee of Calibra, decides to put, Chinese yuan or the Russian ruble into that basket, and then the US government, is very, very angry about that, then it's going to leave the basket, right? So it's not exactly an independent.
Are you saying that the US government can force Facebook to not include the US dollar in the basket?
No. It could force them to exclude a currency that's like the Iranian rial, right? Like for example, some country that's we're supposed to be boycotting or something.
Maybe, but I don't. But unless we get into a hot war or more serious situation with China, I don't think that we have a basis for excluding the ruble. I don't think we can exclude the ruble, for example. I mean, there's nothing illegal about a U.S. person owning a ruble. Right? There's nothing illegal, I don't think, about the U.S. person owning North Korean, whatever the hell they use.
No, that is true. But by having it in there, I don't know. See, the question is going to become this: how much influence does Facebook actually have over this currency? Is it really independent, or does Facebook have control? So this is a toe in the door of private currencies competing with public currencies. But that's it. It's a foot in the door of a private currency competing with a public currency, but it's literally just a toe because it's not really a private currency. It's a private stability mechanism underlied by public currencies, and the transactions are not going to be unconfiscatable. The transactions are not going to be censorship resistant, and the currency itself does not have a mathematically provable, hard money cap of, let's say, 100 million tokens, because they can always print more. So it's not that different than government currencies. Like, I just don't see it as being some kind of innovation. Like, it's not. Bitcoin is the innovation. So I don't really see all that much relevance to Facebook having this currency. It's just another currency. It's like, it may or may not be globally popular. I have no idea. Are people going to like this currency more? Like in the US, probably not. People are going to stick to the US dollars. But in the foreign space, yeah, maybe someone in India would prefer the Facebook currency over the US dollar. Maybe it's easier for them to use if through the Facebook app. So I see it as like actually helping the developing world. So I don't see it as a bad thing. I don't see it as competition, but I love the fact that the governments are so stressed out over it and they're putting so much attention onto it that, look, the more government resources get stressed, I guess it's bad for us because now we have to pay more taxes because now they have to do more work. But at the same time, they can't police everything, right? So the more they focus on Libra, the less they focus on Bitcoin. So I'm okay with that.
I hope that's true. I hope, no, seriously, I hope Libra takes there's 2 points of view on that. There's the point of view that Libra takes the arrows that would otherwise be aimed at Bitcoin. The other one is that Libra seems to have triggered and accelerated the governmental response in the US in a way that the slow approach of Bitcoin didn't. And Bitcoin may be caught in the flack. But I don't know the answer, but there seems to be both things happening. But we'll see.
All right, Gordon, thanks again for joining. How can people find you if you want them to?
I'm one Google search away, actually. I'm on Facebook public. I'm on LinkedIn public. It's cryptolawpartners.com. But, Gordon Einstein is pretty memorable. So I've opened accounts on Facebook and LinkedIn, so they can just reach out. Even Instagram. It's a Gordon Einstein. All
right, awesome. Thank you so much for joining. This has been another awesome episode of the Bitcoin Law Review. And I've been back in the day, this was almost once a week. Now it's once a month. But we will try to bring you more of these. Now that there's more lawyers in the group, we should always be able to, pull 2 or 3 of them together. And I will try to bring you guys another one of these shows soon. Please check out the links to everything in the video description. And I will see you all tomorrow for probably maybe the daily brief, maybe trading Bitcoin, who knows? This is like my YouTube is always becoming a 24-hour news network here. Thank you so much, guys, and I will see you all on the next one.
Thanks.